Hey gang, welcome. It's another video market analysis. My name is Dennis Tubbergen. Today is Wednesday, March 21. Happy spring to everybody. Hey, on today's market analysis, I want to just share with you some of the dynamics of using a Japanese candlestick chart to do market analysis. Now, the chart I have on the screen in front of you today is a daily chart of the Dow Jones Industrial Average, or I should say, an exchange-traded fund that has the investment objective of tracking the Dow Jones Industrial Average. It's DIA. And I've got a chart here that really goes back to almost the first of the year, the first part of January. What I want you to see here is that the length of the candlestick charts, the price action that you see, whenever you have a lot of conviction in the market as to the direction of a trend, you see these bodies lengthen. And if you're not familiar with the chart, these bodies actually, so for example, on the red bar here that I'm highlighting, where the price action went down for the day, you see the open is at the top of the body. The high point for today, the day is at the top of the wick here at the top side. The bottom of the price action for the day is at the bottom wick, and it closed here. So we have the high for the day, the low for the day, the open, and the close. Now the very next day, you see that the market opened much lower, and it shot much higher for the day, and the high point and the low points were just a little bit off the open and the close. Now, 2 days from then, you see another long body that shows that the market really opened and just fell pretty much all day. The open was the high and the close was the low pretty much. The thing to pay attention to is whenever you have candle bodies that are narrow, typically these last for 1 to 5 days or so, and then we have a pretty significant price move. So it takes a while for volatility to contract. Now, if you take a look at market action yesterday was really quite subdued. There wasn't a lot going on in the Dow. In fact, if you take a look at the other up days, there wasn't a lot of price movement. On the other hand, the down days show a lot more conviction. Those candle bodies are a lot longer. The other thing to take a look at is the volume chart that I have here at the bottom of the chart. You see that if we track the down days have much higher volume than the up days. So that makes us think that we're going to see the next move in the markets be down potentially. And the other thing you want to take a look at on this daily chart are I've got Bollinger Bands drawn here, and that's 2 standard deviations in price over the last 20 days. So if you take a look at these Bollinger Bands as they tighten up, often we see a pretty big move from these tightened areas where price hasn't been moving much. Notice how wide they got here after the big downturn in the market, and now volatility has been contracting. And often you see a big move from low areas of volatility, which follows, since a market can only stay volatile for a very limited period of time. Now, if you go back and take a look at the Dow on a weekly chart, same thing. We've got the same Japanese candlestick chart here. The one thing I would have you take a look at is if I were to draw a line on the chart here, I'll just draw a horizontal line roughly across here. You'll notice that stocks kind of broke out here, and if I were to zoom in, you'd see they broke out on a pretty big move week-wise. So if I see where that bar is, you see that prices broke out. We've got a really wide candle body, a lot of conviction in the market. That preceded this great big uptrend. Now, if I were to go back out again on this chart just for perspective, take a look at the shape of that chart. The shape of that chart is really parabolic in nature. You see how it went almost straight up? Whenever you see a move like that, you almost always see that mirror image form. And the market's struggling here to really come up with that downturn, but we expect that that's likely going to happen, at least back to that line that I drew here at about on this 186. So that would be about a 25% decline that we think is likely built into the market. There's another indicator that would seem to confirm that. This indicator at the bottom is what we call the MACD indicator. It was developed by a gentleman by the name of, I believe, Gerald Apple. And if you take a look here, you've got a moving average line and then you've got a moving average of the difference between a couple moving averages. So essentially, it just tells you the market's current consensus of value. And if the fast-moving line is over the slow-moving line, the market's current consensus of value is greater than that over a longer time frame. So that means the uptrend is likely going to continue. And there are traders that will just trade these crossovers. So you see that we have a pretty significant decline coming here in the market as well, because markets are overvalued. And if you take a look here, you see these bars. As these bars start to contract, that tends to show that that trend is going to continue. So when you do analysis, there's not any one thing you look at. There's several things you look at, and that's just a real cursory glance at why using a daily Japanese candlestick chart and a weekly Japanese candlestick chart for the Dow, that we think that the downside likelihood here in the markets, or the market's likely move next, is down. And we think that that could come perhaps fairly soon. So that is today's video market analysis. Today is Wednesday, March the 21st, and I'm Dennis Tubbergen.